Assalamu alaikum wa rahmatullahi wa barakatuh. Bismillahir Rahmanir Rahim. Alhamdulillahi Rabbil Alameen. Wassalatu wassalamu ala Sayyidil Mursaleen, Sayyidina Muhammad wa ala alihi wa ashabihi ajma'een. Amma ba'd. Alhamdulillah, the Islamic finance sector has been growing from country to country, from sector to sector. As a whole, Islamic finance is not seen as one simple sector. It now has three clear divisions. It has the Islamic capital markets, Islamic banking, and Islamic insurance or takaful, which define holistically what Islamic finance is about. But the application of Islamic finance or the progress of Islamic finance within any specific country is highly dependent upon not only the population, meaning if the target population is largely Muslim, that is not the only requirement. We know from previous research, for example, Rivlin 2009 and others, Imam Podar, that what promotes Islamic finance within a country is that the population is Muslim, but the income is also fairly medium or middle class to upper class. And this promotes Islamic banking survival or Islamic finance as a sector in the country. But going forward, we've seen that the issue of regulation plays a significant role in the success of Islamic finance and banking in that country. Now, if we quickly scan over the current regulation internationally, we will find that very few countries in the world have actually taken this regulation from a sophisticated perspective. We quickly look at probably the most successful country in terms of marketing, in terms of penetration, in terms of the diversity and variety of product offerings, and that would be Malaysia. So when we look at Malaysia, we realize that they have clear Islamic capital markets structure, they have an Islamic insurance market, they have an Islamic banking market. It's very clearly defined simply because the regulation is extremely robust. The Malaysian concept has always been that regulation comes in first, then the product comes in. In many countries, you have it the other way around, where the product offering usually dictates the regulation that is required. But in Malaysia, when you're looking at establishing regulation first, it means that you will open the market from a marketing perspective. Everyone knows exactly what to expect. So this means that if there is standard regulation, then any new entry will understand what the benchmark is, what the standard is, what the requirements are, and can quite easily check the necessary boxes to enter into the market. So we're saying that the lack of regulation is a barrier to Islamic banking and finance entry into a market. This is a very important concept. Because if we look at Malaysia and we go back to 1982, 1983, we find that the first formal regulation internationally through the Bafia Act in Malaysia was or allowed Islamic banking to expand at a rapid rate. Yes, they had restrictions on the number of entrants in the market for a few years, but that opened, of course, and when it opened, you had Islamic banking windows. They've evolved from Islamic banking windows to Islamic banking subsidiaries. They have a fully fledged Islamic capital market, the largest sukuk issuer in the world. So every aspect and every sector of Islamic finance is well serviced in the Malaysian environment. And we're suggesting that that is because they have sound regulation. In every aspect, you have regulation. So advanced that whilst many countries have no sukuk regulation at all, Malaysia has already implemented socially responsible guidelines for new types of sukuk. So, again, countries are still implementing basic regulation on sukuk. Malaysia has implemented sukuk regulation. They've gone one step further. They've actually implemented regulation on SRI sukuk. Now, when you look at it in that context, then you realize that the success of the Malaysian sukuk market is because the regulation is robust. If you look at another example, Malaysia is one of the few countries, and when I say few countries, there are probably only 3 countries that have a functioning Islamic money market. but it's only Malaysia that has a successful, well-used or well-utilized Islamic money market globally. An Islamic money market in itself, when you're saying it, you realize that you already have a bit of a conundrum here, because, or a bit of a paradox, because you have Islamic money market, and money markets are really the selling of money and the renting of money. So how do you rent money Islamically? Now, that in itself is a misnomer, because the methodology is really based on Sharia parameters, the mudaraba structure, the wakala structure, etc. That is what is being practiced in the Islamic money market. The success of the Islamic banking in Malaysia relies a lot on this money market. Through an interbank money market, the banks that have illiquidity, or they have lack of sufficient liquidity, they can actually utilize Sharia funds, Sharia compliant funds from banks that have excess liquidity through an interbank market. So there's an overnight placement, and now there's a transfer of funds from one that has excess to one that has a deficit, and that is because there is a money market. So in countries where this does not exist, and that is by far the majority, you have many challenges. You have pure benchmarking against the interest rate. You have a lack of treasury instruments, Islamic treasury instruments, and you have the slow progression of Islamic banking in that country. So if you look at newer countries, meaning countries that have recently introduced Islamic banking, then you will find that few of them have actually had robust regulation. And here we can talk about certain African countries, like Nigeria. Nigeria has a very robust regulatory framework when it comes to Islamic banking, and even now, the Islamic capital market. They also have a takaful regulatory framework, which most countries don't even have. Now, it's important because Nigeria has taken a leaf out of the Malaysian regulatory book. By looking at Malaysian regulation, by understanding how it works, they have applied a regulation, a regulatory framework that actually is built for that environment. Now, in Malaysia, you can call it Islamic banking, but in Nigeria, you have religious sensitivities. So therefore, when you're looking at Islamic banking, then naturally the other sector or the other segment of the population is saying, but why don't you have our faith-based finance? How can a secular government introduce a faith-based instrument that is for all the people? And this is a very important point. So when you look at Nigerian regulation, it has adapted itself to the environment. How so? It talks about non-interest banking rather than Islamic banking. And because it does that, it encompasses or it creates a sense of financial inclusion, such that Islamic banking is not only for the Muslim sector. You see that regulation has done this. An Islamic bank will market to a target Muslim population. But the regulation requires that you call yourself a non-interest bank. And as a non-interest bank, as an ethical bank, anyone who subscribes to the philosophy of ethical and moral banking will come and partake of this instrument or of this banking method or model. This means that it's not only the Muslims that are targeted. Anyone and everyone of any religious denomination is attracted towards this bank. And if we look at it from the perspective of the objective of application, we say Islamic banking is not there to solely service the Muslim population. It is there to improve the standard of mankind, of living, standard of living of mankind, standard of morality and ethics. So all of those good things do not necessarily need to be packaged under brand Islam. So in order to move this forward, we're looking at different environments. And of course, I mean, if you have a 100% Muslim population in a country, then your regulation calls it Islamic. That's absolutely understandable. But when you have a sector which is very well diversified in different religions, then you cannot or not, you do not necessarily have to call it a specific brand. And your regulation determines this. So the point here is that regulation plays a significant role, probably the most important role, in the progress of Islamic banking or the Islamic finance sector in any specific country. And this is a very important point. Of course, we have other new entrants, like in December 2012, Oman entered the Islamic finance fraternity. And when they entered, they entered with a 500-page regulatory framework, which was a combination of the Malaysian regulatory framework and the learning process from other regulatory frameworks. So they've combined and produced a highly robust, significantly robust regulatory framework. Again, any institution or any environment requires that the laws are quite clear so they understand the parameters. And that's why when you're looking at practice in Pakistan, in South Africa, which is where I'm from, you have to look at the issue of regulation from an Islamic banking perspective. Finally, in terms of the regulatory issues, one cannot easily practice a murabaha structure in an environment that doesn't recognize the two sales. You have major tax issues. If there are two sales taking place, you have value-added tax. From one side, you have input tax, and you will be charged double. Of course, there's a title transfer when it's house financing. So you will pay double transfer duty. So the taxes accumulate and then make Islamic banking products much more expensive than conventional banking, simply pricing them out of the market. Therefore, you have to look at regulation that's robust, but tax amendments that allow for the success of these products. And the only way to do it is to consider these issues of double taxation, transfer duties, etc., and look at how it can be, allowed that you can move a product or an asset from one party to another, from a financial intermediary that does not attract additional tax. And very often we experience this in a country that's introducing Islamic finance. And the customers would say, the bankers would say, how do you expect us to change regulation? We're just bankers. Regulation comes from the top. You don't expect us to change regulation. We have to work within the limits. But I'd like to point them to the UK. The United Kingdom, that has approximately 3% or 4% Islamic population, Muslim population, they have implemented tax amendments to allow for diminishing musharaka to be successful, for murabaha to be successful. If an environment like the United Kingdom, which is a secular country, could make tax amendments simply to allow for financial inclusion, then what stops any regulator of any country with a majority Muslim population or a significant Muslim population to look at amendments of regulation? It is from the concept of financial inclusion that we consider these. South Africa has a 2% Muslim population, just 2%. But we have 4 Islamic banking windows, we have a fully fledged Islamic bank, we have an abundance of mutual funds, we have takaful. So we have a fairly robust Islamic banking sector, servicing just 2% of the population. And over and above that, we have tax regulation that has been amended to allow for Islamic banking to flourish. In fact, the South African government has issued sukuk, a secular government that has issued sukuk in 2015. So one has to look at the perspective here, that Islamic banking or Islamic finance as a sector can be profitable from a business sense, can be beneficial to any environment, to any government, irrespective of their religious beliefs. Simply, when it is packaged in the proper regulatory initiatives, it has the proper regulatory framework and the advantages of higher levels of morality, higher levels of ethics, social responsibility, where the world is moving now. This is what Islamic finance espouses, and that should come through the regulation, so that through the regulation you will see the progress of this kind of sector, inshallah, going forward.